Thanks, Lizan. Good afternoon, everyone. On behalf of Asian Markets, we welcome you all to the 2Q FY19 and 1H FY19 earnings conference call of Elgi Equipments Limited. We have with us today Mr. Jairam Varadaraj, Managing Director, representing the company. I request Mr. Jairam to take us through the overview of the company's results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you so much, Kamlesh. Good afternoon, ladies and gentlemen. I'd like to first apologize for having shifted this call from the date of our board meeting to today. Unfortunately, there were some delays in both the BSE and NSE stock exchange servers in terms of getting our documents served up. So I appreciate your understanding around it. So going into the quarter results, I'd like to, as usual, look at consolidated numbers, comparing them with the previous year's second quarter as well. Sales has increased by 18%. Our material cost as a percentage on sales has remained constant. And as a consequence, our contribution, the actual quantum of contribution has been significantly better. But our EBITDA has been actually slightly lower than last year's Q2. And I would like to take you through what are the major reasons for that. Two major factors is, one is employee cost to the extent of close to 120 million, and other fixed expenses of about 140 million. So if I look at the employee cost, about half of it, or maybe 45% of it is the normal increase in India. Close to 40% of that is increase in the US, primarily because we are adding some headcount in the US operation as part of our overall big initiative that we have started about a month ago to change our go-to-market process. Otherwise, the rest of it is pretty normal. India increase is consistent with the general salary increases in the country, which I explained to you even in the previous quarter. On other fixed cost, really 53 million out of the 142 million, 53 million is really the increase in operational related costs, which include additional travel, which included besides travel, there's also the maintenance expenses, regular repairs and maintenance. So the balance 90 million, they're all either a timing issue or a one-time issue or an accounting issue. Accounting issue is from this year onwards, we have started writing off all our material procured for the purposes of R&D. We believe that's a more prudent way. In any case, whatever prototypes we develop are eventually sold in the market, and at that point, we will book the profit, and 100% of it will be booked as profit. So we're writing it off because we believe it's a bit more prudent way of managing our accounts. One-time expenses have been consultancy charges that we are incurring in the US and India for the major initiative that we are doing in the US. It's going to continue for the next maybe quarter and a half, and then it will stop. And there were some recruitment-related expenses for the additional headcount that we have done. We've implemented a new CRM. There were some implementation expenses on the CRM. So those are the one-time expenses, major one-time expenses. There are a few timing issues like our repairs and maintenance. Certain additional expenses have been incurred in the first 2 quarters, which will get evened out in the balance 2 quarters. So, by and large, I would say even though the bottom line is not as good, I think the overall profitability structure of the company is very solid. I'm quite happy with the performance done. So the rest of the expenses I'm expecting in the quarters will come down. This is on the general operations. 2 months of this year we had Fulford's. They have done revenue of 126 million. Not as satisfactory as we would like it to be, but I think things are falling into place. I'm quite confident that things will improve towards the intent with which we acquired the company. In terms of net debt, as you know, in the last almost 6 to 8 months, we've had a huge change in the foreign exchange, depreciation of the rupee. So if I normalize it for the excessive depreciation, the debt as of end of September was lower to the extent of about 12 crores as of March closure. So March we had done 157 crores was the closing balance. This is without Fulford. The same number is about 145 in constant dollar terms. So we reduced it by 120 million, 12 crores. So this is really the summary of the financials. In terms of further reduction on debt, we had committed that by September of this year we would be debt free, but that we revised it to March of 2019. But I believe that even that would not be possible. We are starting some very strong initiatives on the back end to reduce inventory. We also expect quite a significant reduction in receivables by virtue of certain arrangements we have done in the Middle East, where we have had some serious increase in receivables. But in spite of all these efforts, we don't see debt becoming zero by March 19. And considering the fact that I have broken my commitments twice, I don't want to make another commitment in terms of when we will bring it down to zero. But I'm very confident that overall control over cash flow is there. It will continue to get better in the future. As far as markets are concerned, both our European and US operations are doing exceedingly well. India, as you know, has done very well. You looked at the standalone numbers. In the standalone, export is a very small difference between the previous quarter to this quarter. So it's driven primarily by India performance, and we're quite pleased with all the initiatives that we're running. We're continuing to push for it. The economy seems to be indicative of some rumbling. On the construction and mining, there seems to be slowing down on road projects, significant slowing down road projects. Industrial, certain verticals are beginning to show some signs of wanting to go slow. So we'll have to wait and see what the economy situation is. But our presence in the market and our processes continue to grow from strength to strength. So I'm quite confident that the next 2 quarters will be equally strong compared to what we have done so far. So I will stop at this, and I will rely on your questions for further clarification. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Thanks for taking my question. Hi, sir. Sir, just wanted to know, I mean, you had given a broad outline in the last statement as to how the demand scenario is. First half, we have seen good growth in the standalone business, so that is the domestic business. So can we expect a similar kind of growth momentum in the second half, or as you had told, there's kind of some kind of a slowing down in terms of demand, etc.?
There are some... Well, Ravi, like I said, I can't put an exact number on it. I'm just telling you what is a general sentiment in the market. But so far, we are not seeing any impact of that in our performance. So as of now, I'm expecting the second half to continue the same momentum.
Okay, but if you could give a sense as to, say, basically, say, next year, next 12 to 18 months, so basically the infra side, the industrial side, and general retail-led demand, is it likely to see sustained momentum in terms of growth? It will be really helpful.
Well, I'm not an expert on the economy, Ravi, but from looking at...
compressor demand from these segments. I mean,
yeah, so I can't tell you much about retail because we don't do much of retail. But on the construction and mining, like I said, there are some headwinds on the road construction sector, significant reduction in outlays, combined with the fact quite a bit of lending to this sector, which has been perceived as a high-risk sector, has been significantly throttled. So there has to be an impact of this in some form or the other. But the road construction and generally the construction segment of the business to our total is not significant. That's why I'm not going to make a huge change in what my expectations for the balance 6 months are, based on that. Industrials the inquiry levels continue to be healthy, but there are customers who are wanting to delay purchases, so we have to wait and see what the impact is. Automotive is clearly showing signs of slowing down, so our automotive equipment business is indicative or is reflective of that in the second quarter. And I expect that the next 2 quarters also there will be significant pressure on our automotive equipment business.
And in this kind of scenario, what your sense on your market, LG's market share, would it have increased, or we would have been able to maintain market share in the compressor space?
I don't think we have lost market share. That much I can tell you. But, competitors don't necessarily share their numbers very honestly with us. So we find it very difficult to come up with an exact share of the market. But considering if I take into account the GDP growth or an industrial production index growth, apply a certain factor to inflation to it, I think we are doing good. Yeah. But I can't put a number on the table and say this is really a market share. Maybe you can help us. You can go talk to our competitors and figure out, come and tell us what their numbers are.
Sure, sir. We'll do that. Sir, and my last question is at a subsidy level also, there's been something like 21% kind of a growth.
Which one, Ravi?
Subsidiary level. So,
Concall
minus. So, that is... would it have been contributed by the strong growth in US? So how is the scenario there? How is the profitability scenario there for that?
Except for operations in the Middle East, all our and Brazil has been pretty flat. Middle East has been lower than last quarter. But except for that, all our other subsidiaries have grown. So it's not just one subsidiary contributing. But like I said, Europe and America have done a big contribution to that.
Okay, and there too in US, so past few quarters you have seen very good growth. Do you see such a kind of growth sustaining in Patterns and LG USA, given the robust growth outlook that is there in that country?
See, the economy is the largest economy in the world by far, and if it is growing at 3% for the last almost year and a half, 2 years, it's a scary prospect. I mean, such a large economy growing at such a high percentage is something that we all have to watch out for. But our position in that market, like I have always explained, our position in the market is so low in terms of share. Economy growing or not growing will have a lesser impact. I'm not saying there's going to be no impact, but it'll have a lesser impact on our growth because our growth rates in the U.S. have been even before the U.S. economy started growing. So I'm reasonably confident that we will gain traction there.
Got it, sir. Thanks a lot. I'll come back in the queue.
Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is on the line of Amanjeet Singh from Panthomat Asset Management. Please go ahead. Amanjeet Singh, your line is unmuted. Please go ahead.
Hello. Good afternoon, sir.
Good afternoon.
Sir, could you please, give us any guidance on basically the implication of the BS6 norms and basically how it's supposed to come by April 2020? And, is there any demand by OMCs or, the oil refinery companies? And what are you seeing there?
We are not participating. First of all, we don't supply to the oil and gas industry inside the refinery complex. We supply only outside. So we haven't seen any surge. We are not participants in that surge. So that's not our business.
Okay, got it, sir.
Mr. Singh, are you done with your question?
Sorry?
Are you done?
No. Yeah, that's it. Thank you.
Thank you. The next question is on the line of Ishit Seth from Anvil Shares and Stock Broking. Please go ahead.
Hi, good afternoon, sir.
Hi,
sir. Just wanted to check. So in terms of a cost structure, if you look at the overall cost structure, you mentioned there were a couple of one-offs in terms of the consultancy charges and the employee cost being higher for our Indian business. How are we supposed to look at this cost structure? For example, the consultancy charges that we are paying for various activities which we did first at the standalone business and now at the subsidiary business, it has been going on for a fairly long period of time. Now, you said in approximately 2 quarters it will come down to negligible. So could you quantify what this amount would be in the consolidated expenses?
The total amount in the consolidated so far is about 36. Hold on a second. 46 million.
46 million for this quarter.
Sorry. I got to get the number right.
Yeah.
It's about 33 million for the quarter.
33 million. Okay. Sir, even if I were to remove this 33 million, the other expenses are still very high. For example...
No, like I said, that's only consultancy relating to our business. There were other expenses relating to our CRM implementation that we did.
Okay.
There is some recruitment-related costs that we have incurred.
Sure.
R&D expense in both Elgi and ATS from the 1st of April of this year, we are writing it off as opposed to just taking it up as a provision, right?
Okay.
There is also some one-time expenses on training, on provisions for next year's expenses in the Hanover show. There are some maintenance, which is a timing issue. We are within budget and within last year, but it's been front-end spent. So it's not just one thing; it's a multiplicity of many things.
Okay. So all those all those expenses combined, as you mentioned, would be to the tune of 14 odd crores.
Yeah.
For this quarter. Okay. Fair enough. So then also, second question in terms of the employee cost. If I were to look at, as you mentioned in the standalone business, at least for the next couple of years, your employee, you need to match it to at least to some international standard, because of which the employee costs are likely to remain higher.
Yeah.
Is that correct? Okay.
Right.
And even in the consolidated side, the employee cost for this quarter has again shot up very significantly, if I were to remove the standalone from it.
Correct. So, as part of our initiative in the U.S., for which we are incurring the consultancy, we have increased a certain amount of headcount.
Okay, sure.
So, that will if the impact of that we will see next year.
Okay, so that impact on the top line we'll see next year, basically.
Yes.
Okay, fair enough. Okay, so that's it from my side. Thank you so much.
Thank you.
Yeah.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, very good afternoon, sir.
Hi, Manish. Good afternoon.
Sir, just continuing from the previous speaker. So, to get a sense that out of this one-time related, how much do you think would not be recurring in, say, probably half two or, say, Q3 and Q4? Because there were certain, like you mentioned about some maintenance-related expenses which were higher in the current quarter. So, I believe that will probably not recur to similar extent in Q3 and Q4?
Well,
or if you can quantify that 9 crore number, what you said was something timing and accounting related issue, how much of it do you think will recur and will probably not be in
the second quarter, we will have a recurrence of probably, second quarter and second half, I can't say exactly when because it's
sure.
across. In the second half, we will have a recurrence of about another 40. Yeah.
Okay.
After that, it should go away.
Okay. So probably, next year we will probably not see similar numbers. Okay.
Unless I create new adventures in different places, Manish, which is very realistically possible, right?
Sure.
It's growing, right? Yeah.
Agreed. And so that is probably also impacted if I probably look at our international margins, which has gone down. It is a kind of a function of this some headcounts increase in US and some one-time expenses.
Yeah.
Okay. And would it be possible to share now what's our international sales contribution in Q2 or first half as compared to also last year, and how much is the domestic sales, sir?
Percentage of sales, India to in 18-19 remains pretty much the same as last year. It's about 58-42, Manish. 58
is domestic, pure domestic, which excludes exports, right?
Right.
Okay, 58-42. It's not much. It's not changed much.
No.
Because domestic. Okay. Because you mentioned in your initial remark that domestic growth has been quite strong and exports have been kind of flattish.
No,
right?
but the subsidiary sales are included in the 42, no?
Correct. So, okay, so overseas...
So, they are selling from past sales to the inventory that was sent there.
Sure. Right, sir. And in domestic, the growth what we have seen has it like we have seen from any particular segment like industrial or railways or something which has done extremely well, or if you can just probably give some more granularity in terms of what's driving the growth?
All the sectors have grown. The industrials have grown, construction, mining has grown, railways have grown, even water well has grown marginally. So I wouldn't say that there is any one sector. Even within industrials, we have seen growth across all industry groups, whether it's in textiles, in sugar, in cement, in steel. We have seen growth everywhere. So it's not any one product vertical or an industry vertical that has contributed in any significant. And
has the project sales also picked up, sir?
Very, 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 very little. Not almost. We can say it's negligible.
But are we seeing inquiries improving because steel industry seems to be started doing well? And
inquiries are coming, but like I said, the conversion times it's taking long, right? Inquiries are there.
Okay. And sir, on spare parts, we were kind of trying to restructure and redo our strategy. So how are spare parts business doing, sir?
Spare parts as the group has grown higher than the product group.
Overall?
Yeah. So I don't want to get into the exact numbers, Manish, for obvious reasons.
Sure.
It's a healthy growth. We still are pushing it. We still see potential, and we'll continue to grow that area.
Sure, sir. Thank you so much, sir. Thanks a lot.
Thank you, Manish.
Thank you. The next question is from the line of Kirti Jain from Sundaram Mutual Fund. Please go ahead.
Sir, first question is on the air audit initiatives which we are undertaking. Sir, have we achieved significant breakthrough through those initiatives? And secondly, we were trying to prove that we have the most energy efficient product. Are we getting success in the US market because of those initiatives, sir? These are the two questions from my side, sir.
Yeah. Well, the air audit is not a blanket strategy, Kiki. It is more of a specific thing that we do for specific customers as part of our effort to reduce the overall life cycle cost to the customer. There are still a large segment of customers are not really open to doing an air audit before making a purchase decision. We are working at it, but wherever we have done it, there has been significant savings for customers, which has been appreciated by the customer. So our long-term goal is to see how to increase the percentage of every sale with an air audit. It's an audit-based sale rather than just a pro forma invoice-based sale. And the second question, having a highly efficient product in many categories, the most efficient, is for LG just a right to play. It doesn't give us the right to win. So it gives us the ability to play in the US market, but our winning in the US market is not just because of the product. We have a network, we have people, we have process, which we are trying to improve now through the consultancy. So it's a combination of multiple things. And no doubt the product has contributed, but it's just one piece of the right to play rather than to win.
Sir, but we got those certifications, sir, which certifies that LG is the most air efficient, energy efficient.
No. There is no certification anywhere about the thing. It is a independent body that independently measures the performance of the compressors, and it is published in their website. So they don't rate it. It is up to the customer to go and look at the published numbers.
Okay. But that process is over, right, sir?
Yeah. That process.
Thank you. Thank you, sir. Thank you, sir.
Thank you. The next question is from the line of Harish Biani from ICICI Prudential Mutual Fund. Please go ahead.
Yes, sir. Thank you. So we had a medium-term target to achieve a revenue of around $475 million USD, presuming rupee remains at 65 USD to INR. So based on this, where are we in that journey right now? So we had reworked on the entire strategy, had this consulting firm, and you also shared a lot of details in the analyst meet. So as of today, where are we in that journey? What are the key things that would be required incrementally to achieve that particular number? And how long, as of today, where we are and what you see, how long should it take for us to achieve that particular target, sir?
To first answer your question, in a summary, we are on track towards moving towards that number. Unfortunately, I gave you the number in dollars, but thankfully you have normalized it to 65. So, and that we are moving along. In terms of the time frame, our goal is 2022-23. That's what I had projected in the analyst meet, and we're well on the way. There's no problem. And our initiatives in the U.S. that we have started, for which the expenses have been booked this quarter, are as part of that goal. We are very confident that we will see significant traction. Of course, we have to go through this phase of having to invest some money towards realizing it, but we are on the right track. Europe, I'm optimistic Europe will start expanding further for our business from next financial year onwards. We're getting the leadership team in place and the organization in place. Once that is there, I expect that to also start looking as good as the U.S. Australia, with Pulford, we've got a very strong foundation. We are pushing hard in both Indonesia and Thailand. We have got a new strategy that we are working on in the Middle East, and we have already recruited people and the team, augmented the team there. So all these put together will only kind of accelerate our movement from where we are today towards that goal. So we're well on the way.
So, sir, is it safe to kind of say that all the investment that you are doing, one is obviously the balance sheet investment, but the P&L investment that you are doing, that should kind of continue a little higher than the normal, at least till 20, and the benefits of those will be realized over 21, 22 onwards?
I think the expense that you have seen this quarter, like I was answering to someone else's question, you will see it to the extent of about maybe 40 million, 45 million in the second half. After that, we don't have anything visible in terms of a significant expense that is being planned as far as the U.S. is concerned. Now, Europe is a different thing. We still haven't finalized our very clear strategy. So what we are going to do in Europe is something that we will know closer towards the first quarter of next year. At which point we will create the necessary budgets for making that happen. But till then, I don't see, beyond this next half 45, I don't see a repetition.
Okay. Sure, sir. Thanks so much, and all the very best.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Sir, thanks for taking my question again. Sir, you had this is just a follow-up to the previous question. So the target of 475 million, how much of it would be inorganic/organic kind of a growth? And if you pencil in the kind of CAGR, revenue CAGR, say by 2022 that one needs to do, it's like around 17-18% kind of a growth that at Concall level that we need to look at. So basically, if you see, how much of it would be driven by India revenue? Because historically, over a 4 to 5 year period, the industry hasn't grown that fast except for the period between 2003 to 2007. How much of it would be driven by India growth? How much of it would be driven by outside India kind of acquisitions further? If you can throw some light, it would be really helpful.
Well, the acquisition part, we can only talk about what our expectations are, provided the guy I want to buy is willing to sell, Ravi. So I would not venture to make any firm statements. As far as 495 is concerned, we have really not planned any significant achievement as part of our number. It's not 475, by the way, it's 495. So the compounded average growth rate is anywhere between 17 to 19%, and we are tracking to that percentage of growth, right? And with the initiatives happening in large markets like the US and some of the negative markets like the Middle East coming back upon, and with the acquisition in Australia contributing to that as well, doing that 17 to 19% compounded growth rate, I don't see a challenge without any inorganic. Any inorganic opportunities come along, I'll be just on top of that.
Okay, sir. Got it. Thanks, sir.
Thank you.
Thank you. The next question is from the line of Arun Bharti from Puri, Washington. Please go ahead.
Good afternoon, Jay.
Good afternoon. How are you?
Yeah, good, Jay. I have a couple of questions actually. The first one is on this pull forward. While talking about pull forward, you talked about a number and then you said it's not as satisfactory as probably you would have liked. I just want to get some color on that. So that's my first piece. Then the next piece is on the balance sheet, right? I see some movement in the consolidated balance sheet between March 31st and September 30th in property, plant and equipment, goodwill, and as well as in other intangible assets. I just want to know whether this is driven by pull forward or is this driven by some other capex which we are incurring in the rest of the international market.
Yeah. Okay. All right. So revenue is not as per our budget. We have our own internal budget based on which we looked at it, and we were not happy with their performance in the first 2 months. But there are assignable causes for this. There has been some transition in terms of time of the management team to comply with all the accounting requirements, the audit requirements, and the acquisition completion. So there's a bit of a distraction from the management that has caused a little bit of that. So we are reasonably sure in the next couple of months they should be back on track. Things are happening. We are also spending a lot more time with them in helping them get to those levels. So I'm reasonably confident that it's just an aberration. As far as the goodwill, the main thing is the pull forward thing. I mean, we have done some investments in plant and equipment as part of our ongoing, balancing. Like I explained, our capacity growth doesn't happen with linear investments. It's a stepwise investment that happens.
Okay.
So we've done a few investments in that this year. We also have started investing into our motor project, which I've announced in the previous quarter. It is getting ready. We are hoping that production, at least trial production, will start this quarter, and some amount of regular production will happen next quarter. These are basically nothing significant, but the goodwill comes from the Pulford acquisition.
Got it. And Jay, what is this other intangible assets? It has actually gone up from something like 5.3 crores to 42 odd crores. Is this also driven by Pulford?
Yeah, that's Pulford. Yeah.
Got it. Okay. And what's our total capex plan for the year actually? All put together?
Total plan that we had earlier projected, including the motor plant, would be, we thought it will be about, a normal is about between 35 to 40 crores. This year maybe a little bit more because of the balancing. So overall I think it will be about 60. Between 55 and 60 is what I expect.
Got it. Including this motor project, right?
Yeah.
Okay, got it. My next question is on the debt side, on the liability side of the balance sheet.
Only two questions, Aruna. So.
Okay, can I ask one more or should I come back?
No, go ahead. I was just pulling a leg.
Okay. No, on the liability side of the balance sheet, our debt has gone up from 60 crores on the long-term borrowings under the non-current section. This has gone up from 60 odd crores to about 104 odd crores, correct?
Yeah.
And similarly on the current side, it has actually gone up from something like 162 odd crores to 182 odd crores.
Yeah.
Is this completely explained? Can this be completely explained by the currency depreciation, or have we taken on some more debt actually?
The debt has been taken on. The additional debt was taken on primarily for the Pulford's acquisition.
Okay.
The currency depreciation that has impacted is close to 20 crores. Yeah.
Okay.
Is the change in the rupee value of the debt because of currency.
Got it. Okay, that's all from my side.
We have not taken any additional debt for normal operations. The only debt we have taken is for Pulford.
Okay. That's fine, Jay. That's all from my side. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Ritvik Seth from Deep Finance. Please go ahead.
Hi, good afternoon, sir. Just one question. So right now we are investing in our capabilities. So in the long run, say 3 years or maybe even further down the road, what is the kind of margin profile that we are looking at once we start reaping the benefits of all the current investments?
At what level?
At consolidated EBITDA margin.
EBITDA margin. Well, what we are investing right now is not going to change our contribution margin significantly, and it certainly doesn't affect any of our fixed costs and therefore the EBITDA. Our primary investment in the motor plant will give us some, the investment in our motor plant will give us some marginal benefits in terms of cost. The entire motor industry or the motor efficiencies are moving up. We had planned for IE2 and IE3 standards of efficiency, but already the standards are moving to IE3 and IE4. So at this point in time, I don't know what will be the extent of additional profit we can earn by making our own higher efficiency standard motor. It should be only higher. So there will be some improvement, maybe to the extent of about, the motor constitutes only 30% of the total cost of the compressor, less than 30%.
Right.
So in that we may end up saving about 4 to 5%. So 1.5% is what we can get, but not across the entire turnover because we are going to make only motors up to 45 kilowatts.
Okay.
So there could be a 0.4-0.5% impact on our contribution margin. Now, I don't expect anything significant beyond that.
Okay.
But more important is we will be able to improve the quality of our product because of the designs that we have created as well as the manufacturing standards that we are putting into the plant.
Okay. So any ballpark figure, say 3 years down the line, we are looking at 12% plus EBITDA margin. Is it possible to do that?
Our EBITDA should have been close to about 16%. It's only these expenses that are one-time in nature that have really cut that down. So our goal is upwards beyond 16% over the next 2 to 3 years.
Okay. So you mean to say that in H1 FY19, if we normalize, all the one-time costs that you said, our EBITDA in absolute terms would have been around 120 odd crores?
It would have been close to about 16%. I don't have the numbers.
Okay. Yeah. So that's a 500 basis point impact for the first half.
I don't have the number, but last I did the calculation of the EBITDA percentage. We said that if we add back the one-time expenses, we should be able to get.
Oh, okay.
Huh?
So we're confident to do that in FY20 once all these one-time costs go away.
Yeah.
Great. Okay. Thank you, sir, and all the best.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. As there are no further questions, I now hand the conference over to Mr. Kamlesh Kotak for his closing comments.
Hi, Jay. A couple of points if you can help us. How has been the railway segment and the spare parts business this quarter, and how you see them going ahead?
Both have been very good, Kamlesh. The railway business has been good because there has been quite a bit of budgetary support for building more locomotives, so that is done well. Aftermarket, like I explained to you, we're continuing to grow. Our percentage of growth is higher than the product percentage. So,
okay.
It's been good.
And, sir, how has been the utilization at compressor? Are we close to any higher utilization which will entail further bigger capex next year? How we stand there?
No big capex next year. Like I said, this year we've got more than normal levels of capital investment. That is something that we started last year. Part of it was invested this year. It'll get completed this year. Some more has been invested this year. So like I said, it's not a linear movement in capacity and investment. So there's a step. So we had to invest in this step to extract some more capacity that was available in the plant with other machinery. Now, once this is done, maybe in another year and a half, we may have to again do some balancing investment to extract some more capacity.
Mm-hmm. So, optimally, what would be utilization level currently in compressor and foundry, both plants?
Foundry utilization is only about 35%.
Okay.
Because we are running only one shift. We have capacity for 2 shifts. In the compressor plant, it's very difficult to say exactly what's the utilization because the same equipment is used for so many different products.
Sure.
Across different sizes of compressors. So in a given year, let's say for instance, if the borewell compressor market picks up, they're all large air ends. The capacity demand will suddenly go up. But because the borewell market is down now, the capacity utilization looks like it is lower, but actually the number of compressors that we produce much more. So, it's very difficult to say.
Okay. And any color on the oil-free compressor demand? How has that segment done?
We've done well. Like I said in the past, it's an initiative that we've been running in India, India focused. It has had a pretty significant growth in the first half. We expect that momentum to continue. We've also started selling our new technology of oil-free technology. We've already got quite a few installations in the field. We are going to launch that in Hanover, in Germany. We're all getting ready for that. So it's quite exciting there. So all looking good on the oil-free side.
Any specific sectors which looks to be promising in terms of the demand for oil-free currently, or maybe the way forward?
There are only 3 or 4 segments that are big consumers of oil-free, Kamlesh. Besides the project businesses like power and steel, if you take that out, on regular product sales, it is food and beverages, pharmaceutical, and these are the 2 big ones. And then you have textiles, you have a little bit of automotive, but food and beverage and pharmaceuticals are the big industries.
Sure. Okay. Great. So thanks, Jai, for those all